I'm Charles Pope. I'm the Chief Financial Officer at Seagate Technology.
Gervais, the only authentic French restaurant in Silicon Valley.
In general, we were a little bit better than the guidance that we gave in January. We feel very good about the quarter. Normally, the March quarter is seasonally slower demand, and we saw that, but we still represented, what was it? It was 16% revenue growth, 20% earnings growth year over year, and a year ago was a record for the March quarter. This is a new record for the March quarter, and so we feel very good about that. I feel good about the operating results of the company during this quarter. I think that at times the analyst community gets a little ahead of expectations. I think that in September and December quarters, where we came ahead of what the guidance was, there gets to be an expectation that you will do that every quarter. In reality, if you look at the guidance that we gave in our call yesterday, it was exactly a repeat of the guidance that we gave in January for the June quarter. And at times people forget that the June quarter is the most difficult quarter of the year in terms of softest demand. It is the most aggressive pricing environment. And in Seagate's case in particular, we are shipping in volume products that we introduced 12 to 15 months ago and are just in the process of rolling out a new set of products, but we're towards the latter part of the life of this set of products, and so it's much harder to squeeze costs out of them and improve the margins. And so most of the questions that we've gotten from the investment community have been around, why is your margin as low as it is? And I think they just don't recognize that at times that the June quarter we have the wind in our face instead of at our back, and then we have a product set that we're in the process of refreshing. We're very excited about the latter half of the calendar year, both from a demand perspective and also from the new products that we will be ramping. If you sat and look at the products today, probably 30% of our desktop represent the latest generation longitudinal, but we still have, 2/3 of our desktop product line that are more than 12 months old in terms of the release of those products. The notebook, we started shipping the new perpendicular notebook in December, the 160 gigabyte perpendicular. It's just barely beginning to ramp right now, and the June quarter will represent a qualification period prior to ramping in the back half of the year. And so all of the 2.5-inch products that we're shipping right now have been being produced for over a year at this point in time. And then the enterprise, it's interesting to note that yesterday we announced the first enterprise perpendicular drive that we're shipping. We call it the 15K.5, but it's a Cheetah class product that has up to 300 gigabytes of capacity based on perpendicular technology. And I believe if you pulsed around the technology community, the IT community, and the investment community, I think most people would have believed that introducing a perpendicular enterprise drive was probably almost a year away. And so I think that this is a big announcement. And then yesterday we indicated that before the end of June we would be shipping perpendicular drives into all of the markets that we serve, including the desktop. And I think in general the IT community and our competitors would have believed that that was more than a year away before we would be shipping into all of them. And so we're just barely starting the perpendicular ramp, but a year from now everything will be perpendicular based, and by the end of this calendar year the vast majority of it will be perpendicular based. So we're very excited about this transition we're going through. Demand is seasonally down during that quarter, and if I just think about it from our customers' perspective, they know that demand is seasonally up in September and December, and so their focus during September and December tends to be making sure that they have their supply chain in line and that they're not going to be missing any shipments for lack of components. As a result, we have a little better balance in terms of the pricing negotiations in September and December. Well, March and then June quarter again are seasonally down. Our customers know that. They feel like the pressure is off of them a little bit and that there's a little bit of flexibility in the supply chain, and so they tend to be a little more aggressive in the negotiations because of that flexibility that they perceive in the supply chain. One of the things that has helped us, and certainly helped us last year, probably didn't help us quite as much this year, is that within the consumer electronic space, DVR, PVR, it's growing at a rate that really doesn't manifest any seasonality. We in fact shipped a few more DVR, PVR drives in the March quarter than we did in the December quarter. Even on the gaming, we shipped a lot more because of the product transition of the Xbox 360. We shipped a lot more in the March quarter than we did in the December quarter. And so that has helped us offset some, but from a pricing perspective, there tends to be a pretty tight linkage from one group of products to another group of products. We hope to have the transaction closed in May. We've already received Justice Department approval from both antitrust and from the Securities and Exchange Commission. We are currently in process with the European Union. Their first stage review is due to be completed April 27th. At that time, they will either give us approval or extend the first stage review an additional 10 days or go into what they call a second stage review. Our hope and the sense that we get is that we're cooperating well with them and they're becoming comfortable with the transaction. So our hope is that on April 27th, they will go ahead and give us the approval to close it. In anticipation of that, or hoping that that's the way it turns out, we've scheduled shareholder votes for May 17th. And if we have received European approval at that time of the shareholder votes, then we'll be able to go ahead and close the transaction at that point. Maxtor has actually been much more successful than we have been on the retail side of their business, integrating drives into solutions that were easily usable by consumers.
The Max Attach.
Max Attach, one-touch backup, those types of things. And we certainly want to leverage the brand recognition and the presence that they have in the retail market and the expertise they have in terms of getting the products there, understanding what the retail market is really wanting and everything else. And so we want to be very careful as we integrate those pieces to make sure that we in fact enhance the value versus damaging any of the value. And as a result of that, we're going to it's pretty easy for us on most of the OEM side to say, hold it, the Maxtor product is going to go away and we're going to service this account with Seagate's products because of the cost structure and everything else. We're absolutely going to let the Maxtor retail organization play a very prominent role in terms of this integration so that we in fact enhance it. And we think that this is a case where 1 + 1 can be more than 2 because they've been very successful in their retail market even though they haven't had leading drives. If you kind of marry our leading drives with their understanding of the retail market and the solutions that they've put together, it ought to be a very winning combination. So we're very happy about that. Not really. They've known for a long time that they don't have a competitive cost structure, and it's when you are already struggling with a cost structure that is not competitive in the industry, it becomes very sensitive to any volume adjustments. And so where they had some volume shifts away from them, which we've talked from the time that we first announced this transaction that there would be some revenue attrition away from Maxtor. Their model is very sensitive to that. During the March quarter, there was some share loss there. In fact, I would characterize it as a point or two of share loss, which, Seagate in the March quarter had a point of share loss on the desktop side. Didn't affect our results. Our model is not nearly as sensitive to that as theirs is. Theirs being as sensitive drove some much more dire results than what many of the other companies would. And so, but it also doesn't affect the cost opportunities and synergies that we have available to us. When we entered into this transaction, we recognized the sensitivity that their model had, and it doesn't negate any of the opportunities to bring that revenue into Seagate with our product set and our cost structure and bring it in at incremental margins of 26 to 28%. Well, let me start with what I think are three of the key contributors to the cost structure that Seagate has. The first is we are vertically integrated with heads and media, and we're the technology leader there. We're not only the technology leader, we're the volume leader in heads and media, which gives us a cost structure better than the TDKs of the world and the Comegs of the world that are supplying heads and media for our competition. And so that vertical integration is a very large cost advantage. If you look at this industry, the companies that are making money are TDK, ALPS, Comeg, Showa. They're the head media suppliers. Then you have motor suppliers. But anyway, so motors and then some of the ASIC suppliers. They're the ones that really make money. The drive suppliers in general are not making any real money. Seagate's profitable, WD's profitable. And if you really measure the amount of profitability that WD has and calculate the number of heads that they ship in their drives and compare the selling price for a head that TDK sells a head for compared to what they produce it for, you'll find that that's about how much money that they make. And so it's really the fact that they're shipping heads that allows Western Digital to make money. As we looked at the Maxtor acquisition, Maxtor, if it had a head business, would be performing as well or better than Western Digital, and Western Digital, without its head business, would be performing at about the same level that Maxtor was. So it's very, very sensitive there. So our vertical integration and our successful execution of our vertical integration is key to our cost structure. The second is the platforming we do across the products, where we platform technology, just like you're seeing in the perpendicular recording, that we develop and then very quickly have the ability to roll it out across a broad set of products instead of having to apply the technology in a very unique way to every single product that comes out. So if you look at the research and development per drive that we produce, it's, and don't quote me on the numbers because it's been a while since I've looked at them, but it's probably a fourth of what our competition's research and development per drive is, because they don't have that same platforming concept, and that includes our head and media R&D. In most of our competitors, it represents only drive R&D, and so the gap is even larger than that. So the platforming that we do on drive development is a large part of the cost advantage that we have and the cost structure that we have, and then the manufacturing platforming that we've done, where you can build any drive on any line, makes very efficient utilization of the capital infrastructure that you have in place. Seagate's really the only company that has all of those embedded in it, and I think that that manifests itself in our results quarter on quarter. Well, Western Digital, and I'll start with them, are executing well. They're a good competitor. They tend to make the most out of what they have and execute it very well. We consider them a very competent competitor. You know, Maxtor is struggling with the cost structure they have and the model that they have. They have a lot of competent people, but just have not been able to achieve the scale and the cost that was needed to be effective in this industry. If you sit and look at the three primary Japanese competitors, it's not clear to us why they're even in the industry. Fujitsu kind of breaks even in their drive operations. Toshiba, whatever money they're making, if they're making money, and I have questions in my mind about whether they are or not, they're making it on the 1.8-inch sales going into iPod, not on the 2.5-inch revenue that they have. And so again, Toshiba has historically had a strategy that has said, we're rolling out new products, we're going to be the technology leader in small form factors. And when Seagate kind of came up underneath them and took over all those small form factors, with the exception of the 1.8-inch right now, and in fact leaped over them to the highest performing products, it took that strategy away from them, and I don't think they quite know what to do with it at this point in time, because it's a very niche strategy and the industry no longer really accommodates a niche player. Hitachi has just struggled with the integration of the IBM assets. Continues to struggle, continues to have not made decisions relative to what product architectures we're going to do, what product lines we're going to do. They're still supporting two. It's been over 3 years, and those decisions still haven't been made, and so their cost structure is horrible. They have the model closest to us where they have vertical integration, and yet they're buying more and more heads from TDK because they've allowed themselves to slip behind in the technology on heads and media. So right now their cost structure is very poor. Their execution hasn't been very good, but they have the ability to be a phenomenal competitor if they start executing well. And then we have Samsung that is kind of a wild card. They probably have the lowest margins in the industry, both because of product mix, but also because they don't have scale or anything. They don't have the right model. They're having to procure heads and media from third parties. And so unless they go and become vertically integrated, their cost structure is going to continue to remain very uncompetitive. And yet they're the wild card. You know, they execute what they do well, and to a certain extent they're the tail that wags the dog. But it's not obvious to me why they want to be in this industry either. That's kind of a rundown. Well, I would say the primary driver of our business is consumer electronics, but it has ramifications within every segment that we ship to. So right now, JVC actually has a drive-based video camera. What happens with that is that people are taking their video cameras or still camera photos that are on drives, going home and putting them on their hard drives in the desktop, editing them, doing backup of them so that it has a desktop ramification. It has an enterprise ramification because people downloading things into their handsets are needing an enterprise server to accommodate that download. And so we're seeing enterprise shipment levels that I think Brian said that for 7 quarters has been over 6 million units a quarter, which has been very high. And IDC and Gartner have consistently increased their growth projections for both enterprise and desktop and notebook. And I think the reason that all of those keep going up is because of this consumer effect that's drawing more into it. Or if you sit and look at the PVR, DVR space, it's grown 100% year over year. I don't know that I necessarily expect it to continue to grow at 100%. It's kind of gated by the content providers' infrastructure where they can push it out. But do I expect it to grow 50, 60% again this year? Yeah, I do. You look at gaming, gaming can grow 20, 30%. Right now there's discussions among a lot of different gamers on, and in fact the 20, 30% that I'm talking about may end up being very conservative depending on how broadly drives get adopted into the gaming environment. Look at the handheld devices. Those are just beginning at this point in time. So consumer electronics, if you average it all together, probably represents 30, 40% unit growth. notebook computers represent 20-25% unit growth. Those are becoming more and more consumer devices rather than just pure business utility devices. Even the desktop is experiencing growth rates that are 9-12% versus 6-7%, and the enterprise is experiencing growth rates that are in the high single digit, 7-9%. And so I think that the consumer is kind of pulling everything along with it, but averaging it all together, you're talking about 20+% unit growth. I feel very confident that it's growing. We believe that for the next 3 to 5 years, unit growth will be 20+% unit growth per year. We came off of a year in 2005 where units were 380 million units shipped in the industry. A 20% growth off of that says that we'll be almost at 460 million units shipped this calendar year. And this quarter we were in excess of 100 million. The general belief is that next quarter we will be in excess as an industry, in excess of 100 million. And then you get into the 2 strong quarters of the year. And so I think we're on track to demonstrate that 20% unit growth. And the unit growth is translating into 12 to 15% revenue growth, which for a mature industry is really strong revenue growth. Feel very good about it. Flash has a positive impact. For whatever reason, they seem to take umbrage with us at times, but we would certainly prefer to have a hard drive in a handheld device, but if we can't have a hard drive, we want some sort of storage in there, because that storage still allows the downloading, requires the backup mechanisms and everything else. Take Apple's Nano. We would have loved to have had our drive in it, but even if they don't put our drive in it, it still requires people loading iTunes on their home computers, downloading everything into iTunes, which requires a lot more storage on their home computers, and in many cases they're buying that online and downloading the music versus just ripping CDs or something. And so the content is now very valuable. They have the content in their hand, even if it's flash. They have it in the computer, which is requiring more storage in their computer. And because they've paid now $1,000 or $1,500 for the content, they're backing it up to a retail drive that we plug in. And so if we can't have a hard drive in there, put flash in it, because it drives these other things that are all beneficial to us.
Does it make sense for Seagate to get into the flash business?
If I had a good opportunity to do that, it would be something I'd be foolish to not consider. I don't see any real opportunities at this point in time to get into it. It would need to be a business model very similar to Seagate's, where there's vertical integration. If you sit and look at it, the vertical integration is contained in Samsung, Toshiba, SanDisk. There may be opportunities for partnering and doing other things like that, but I don't see opportunities for Seagate to really get into the flash business at this point in time. I think the primary impact of the regulatory environment on the CFO is making sure you have a very strong staff around you. I sit and look at what my staff is going through right now relative to the Maxtor acquisition. They have all of their normal jobs, plus they have the Maxtor acquisition work on top of it, and here at the year end they have the SOX 404 certification they're going through and everything else. And they're being worked very hard. And so I guess the biggest impact that it has to me is being mindful of my staff, because in most cases I can't really go in and roll up my sleeves and help them. I understand what the issues are, but quite honestly I would get in the way if I tried to say, let me help you. The thing I can do is make sure that we have staff that really understand the issues so that they can project manage it very well. And then it is requiring some more staff, and so making sure that the resources are going there to be able to handle all of those things, because it's a situation where you tend to want to keep the administrative side of a company very, very lean, and I think it's the right picture to have. But it's one of those situations where the downside of a mistake becomes so large that you say, hold it, let's keep it lean, but let's not keep it so lean that we can have a mistake. Coming out with not being able to certify to 404 will probably have some very negative impacts on public company stocks. If you sit and look at it and say, well, hold it, I need 2 additional regulatory people in the finance staff in order to make sure that I don't run that risk. Okay, is $200,000 a year, how does that compare to taking a hit of $2 or $3 billion in the market value of the company because we couldn't certify? And so I think it's more of being aware of the capabilities of the staff and making sure that the resources are there, and being alert enough to what the issues are so that you can kind of do some of the directing of it. But beyond that, there's not a whole lot that we can do directly. I do almost no accounting. I have a very capable staff. If they are running into roadblocks or have resource issues, they come and talk to me about that, but I really do almost no accounting. And quite honestly, I viewed SOX a little differently than most, where I welcomed it. Accountants like to be process-oriented and control-oriented, and sometimes you get pushback from the operations side of the house on, gee, that's limiting my ability to be flexible. You know, we want to limit you to a certain extent. And so this environment has really created an opportunity for most companies to go and run the way that they ought to have run all along the way. And so I don't view SOX in the same negative light that most people do. It's really accomplishing what we had worked to accomplish within Seagate all along the way. It takes a little bit more of my time, but my time is still focused on what's the strategy of the company, what's the organizational alignment, are the actions that we have on a day-to-day basis consistent with that strategy? When we come up with this idea as an investment, is it consistent with that strategy, or is someone kind of drifting way out? How often do we need to refresh the strategy? Those types of things. And that's where I feel that a CFO adds value, not trying to be a super accountant. If you try to be a super accountant and are isolated from the strategy and the operations and direction of the company, you'll find that you get out of sync anyway, and now you actually have more control weaknesses because over here they're moving in a direction that is different than the controls and the accounting environment and everything else. And so you have to stay on the business side of the company and help translate that over to the administrative side, but you can't move to the administrative side yourself. I disagree with it completely. It's one of those things that I think it's poor thinking. I think it is bad logic. I completely disagree with it, but it's one of those things that's done and I comply with it, even though I think it was very poor rationale, very poor thinking. It is certainly having an impact on the compensation strategies of most companies. There isn't going to be the same level of stock options, which Seagate always operated at the very low end anyway, where if you looked at the burn rate, the refresh rate, or whatever you want to call it, we've always operated in the 2 to 2.5% range, where some companies were up to 8 or 9% a year. And as an investor, I would sit and say, hold it, I'm being diluted 8 to 9% a year, and I'm doing it with omnibus programs where I don't even have a say in it. Give me a break. And so I think that industry brought a lot of the stock option issues on themselves, and quite honestly, I think if if the whole world had managed it the way Seagate had, where it was in the 2.5% range on a gross basis and kind of a 1.5, 0.75 on a net basis, we wouldn't have had this whole, let me call it a revolt. And so it's not having a huge impact on Seagate's comp plans. It's having a very large impact on some others. But even within Seagate, it's causing us to sit and look at who participates, what level they participate at, because it is a scarce resource that we need to manage as a scarce resource versus paper.
Right.
It's primarily cost-driven, but in some cases, it's an indirect means. As an example, much of the systems that we ship to are being manufactured outside the United States. And so it makes a lot of sense for us to be close to where those systems are being manufactured versus manufacturing here, shipping them out, bringing them back. But some of it is government regulation and all also. If you sit and look at some of the tariffs that are set up, and I need to be careful how I say this because I don't want a backlash on it, but if we were to import heads, if we were to import disks and motors and printed circuit boards, all of those are dutiable. But if we put them together as a drive and bring them in, the drive is not dutiable. And I've pointed this out to the government a number of times where they say, well, hold it, our jobs are going away. I say, yeah, you have really lousy trade policy that is driving a lot of this issue. And they don't get it. And so it's a combination. That's a cost still, but it's an indirect cost. It's not where's the talent pool or anything else. We have good talent here in the States. Most of it is international. I mean, if you go to our offices in Scotts Valley, Milpitas, Colorado, or Minnesota, you're going to find every nationality of the world. Many of them here on HB1 visas. And so we're utilizing that talent from around the world here, and you have the ability to do that here. So it's not really a talent issue, it is primarily a cost and logistics issue in terms of where you manufacture. We have media manufacturing here in California. We produce 40% of our media requirements in California. We have some head manufacturing in Minnesota, and then the rest of our U.S. operations are research and development, administrative, and customer service type operations so that we can be closer to the customer base where needed. California does everything they can to make it as expensive as possible in terms of the way taxes are structured and in terms of the regulation and the reporting requirements and just everything they do. Also, it's difficult because a situation where it's a wonderful climate, but
now
actually we like the rain when it comes to, and if it didn't rain in the summer we'd complain about not having enough rain. But the cost of housing to accommodate people, and it keeps going up. The in-migration and the housing strains are tremendous, and you know that's not something that's really brought on by state policy or anything else. That's everyone. A lot of people like to live here, and there is industry, and it drives prices up, but it makes it more difficult to live here, which then drives property taxes and a lot of other costs associated with it. We're very careful about what we bring to California and try to make sure that it's only those activities that absolutely have to be here.
Gervais, the only authentic French restaurant in Silicon Valley.